Let me ask you something. What if I told you that the most powerful wealth-building tool in human history is not a stock? It is not a real estate deal. It is not a hedge fund. It is not some secret algorithm used by Wall Street insiders. What if I told you it is something so simple, so unglamorous, so completely ordinary, that 99% of people dismiss it without a second thought? Warren Buffett, a man who turned $114 into $100 billion, has spoken about this one habit in nearly every interview he has ever given. He has written about it in shareholder letters for over 60 years. He has pointed at it, begged people to understand it, practically screamed it from the rooftops. And yet, today, we are going to change that. Because once you truly understand this one habit, not intellectually, but deep in your bones, your entire relationship with money will never be the same again. Stay with me, because what I am about to share with you will either make you very uncomfortable or set you completely free. The year is 1942. Franklin D. Roosevelt is in the White House. The United States is in the middle of World War II, and in a quiet, unremarkable city in the middle of America, a city called Omaha, Nebraska, an 11-year-old boy walks into a brokerage office with his father. His name is Warren Edward Buffett. With $114.75 he had saved, money he had earned delivering newspapers, selling chewing gum door to door, and collecting lost golf balls, this 11-year-old boy bought his very first shares of stock. Now, I want you to think about that for a moment. An 11-year-old child with $114 in the middle of a world war, buying stocks. Most adults today, with smartphones and instant access to every financial market on earth, are too afraid to do what this child did in 1942. But here is what makes this story extraordinary. It is not the fact that he bought stocks at age 11. What makes this story extraordinary is what he did next. He held them. He waited. He was patient. Not for a week, not for a month, not for a year, for his entire life. Warren Buffett is now 94 years old, and here is the number that will shock you. 99% of Warren Buffett's entire net worth was accumulated after his 65th birthday. Let that land. After his 65th birthday, the man who is considered the greatest investor who ever lived made 99 cents of every dollar he ever earned, after the age most Americans retire. How is that possible? How does a man become richer in his 70s, 80s, and 90s than he was in his 30s, 40s, and 50s? The answer is one word. One single, beautiful, devastating word: compounding. Warren Buffett once said something that I want you to read very carefully. He said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Not genius, not perfect timing, not insider information. Compound interest. Now, most people have heard this term. Most people nod their heads when it comes up. They say, yes, compound interest. I know about that. But they do not truly understand it. Because if they did, if they felt it in their gut, they would behave completely differently with their money. Let me show you exactly what I mean. Imagine you have $10,000 and you invest it at an average annual return of 10% per year, which is roughly the historical average of the S&P 500. After year 1, you have $11,000. After year 5, you have $16,105. After year 10, you have $25,937. After year 20, you have $67,275. After year 30, You have $174,494. After year 40, you have $452,592. After year 50, you have $1,173,908. $1 million from a single $10,000 investment with zero additional contributions, just time. But here is where it gets almost supernatural. Notice what happens in the final years. Between year 40 and year 50, your money grew by over $700,000. In just the last decade of that 50-year journey, you made more money than in the first 40 years combined. This is what Warren Buffett understood at age 11 that most people never understand at 60. The snowball does not look impressive at the top of the hill. It is small. It is slow. It barely seems worth pushing. But at the bottom of the hill, it is unstoppable. Buffett himself explained this concept with what he called the snowball theory of investing. He literally titled his biography The Snowball, and in it, he described his life's work in exactly those terms: finding wet snow and a very long hill. Wet snow is a good investment, a business with strong fundamentals, consistent earnings, and a durable competitive advantage. A long hill is time. Years, decades. That is all it takes. And yet, in a world of instant everything, time has become the rarest commodity on earth. Here is the brutal reality of the world we live in today. The entire modern financial system has been carefully, deliberately, and brilliantly engineered to make you destroy your own wealth. Think about your brokerage app. Think about what happens when you open it. Flashing red and green numbers. Push notifications every hour. Trending tickers. CNBC headlines screaming about the next crash. Social media posts from 22-year-olds bragging about 300% gains on some cryptocurrency you have never heard of. Every single element of this environment is designed to do one thing: make you act. Because Wall Street does not make money when you sit still. Wall Street makes money when you trade. Every commission, every spread, every fee, they only collect it when you move your money. So they have hired the most brilliant behavioral psychologists on the planet. They have studied exactly how to trigger your fear, your greed, your impatience, and they have turned the stock market into the world's most sophisticated slot machine. And it is working. Do you know what the average retail investor's annual return is over a 20-year period? According to research firm Dalbar, which has tracked this data for decades, the average equity investor earned just 4.25% per year over the past 20 years. The S&P 500, during that same 20-year period, returned over 9% per year. The market returned 9%. The average investor got 4%. Same market. Completely different results. The difference was not intelligence. It was not access to information. It was not timing the market correctly. The difference was behavior. The average investor bought when they felt excited, near the top, and sold when they felt terrified, near the bottom. They traded constantly, chasing performance, reacting to headlines, letting their emotions run their financial lives, and they paid for it dearly. Warren Buffett watched this pattern repeat for 80 years, and he made a decision early in his life that separated him from every other investor on the planet. He decided to stop reacting. He decided to think in decades, not days. He decided to be the last calm person in a world of panic. So what is the one habit? You may have already guessed it. But I want to go deeper than the surface answer, because this habit is not simply be patient. That is too easy. That means nothing without understanding the foundation beneath it. The one habit that made Warren Buffett $100 billion is this. He reads every single day for hours. When Warren Buffett was asked early in his career how to get smarter about investing, he held up a stack of papers and said, "Read 500 pages like this every day. That's how knowledge works. It builds up, like compound interest." 500 pages, every day. To this day, at 94 years old, Warren Buffett spends approximately 80% of his working day doing nothing but reading. Annual reports, financial statements, industry publications, newspapers, biographies, history books. His business partner, Charlie Munger, who lived to be 99 years old, once described Buffett as a learning machine. He said, "Warren is better at age 93 than he was at age 83, and he was better at 83 than at 73. Better, with each passing decade, not worse. Why? Because of compounding. Not just financial compounding, intellectual compounding. Every book Buffett reads adds a new mental model to his library. Every annual report he studies gives him a deeper understanding of how businesses work. Every mistake he analyzes, his own and others, becomes a lesson that prevents a future error. Knowledge compounds just like money. And this is the habit that sits beneath the habit. It is not just reading. It is the decision to invest in your own mind with the same intensity and discipline that you invest your money. Most people spend 8 hours a day working for money. They spend 0 hours a day making their mind more valuable. Warren Buffett flipped this equation. He understood that a more powerful mind would eventually make him more money than any amount of physical labor ever could. And he was right. Now, I know what some of you are thinking. That is great for Warren Buffett, but I am not Warren Buffett. I do not have his intelligence, his connections, his starting advantages. And I want to address that directly. You are right. You are not Warren Buffett, but you have something that Warren Buffett in 1942 did not have. You have the internet. You have access to every book ever written for $10 a month on a Kindle subscription. You have free access to every public company's financial statements on the SEC website. You have free courses, free podcasts, free lectures from the greatest financial minds on earth. The information that took Buffett decades to accumulate is now available to you in an afternoon. The question is not whether you have access to the knowledge. The question is whether you are willing to do what most people are not willing to do. Here is the practical framework. 3 things. Simple, powerful, life-changing. Number 1. Protect your attention like it is your most valuable asset, because it is. Every minute you spend reacting to financial news, checking your portfolio obsessively, or scrolling through Reddit for hot stock tips is a minute stolen from building the knowledge that creates real wealth. Unsubscribe. Turn off notifications. Create space to think. Number 2. Read 1 financial book per month, minimum. Start with The Intelligent Investor by Benjamin Graham, the book Buffett calls the best investment book ever written. Then read Poor Charlie's Almanac. Then read The Psychology of Money by Morgan Housel. Each book will compound on the last. Within a year, you will think about money in a way that puts you ahead of 95% of the population. Number 3. Make 1 long-term investment decision and refuse to touch it. You do not need to be brilliant. You do not need to pick individual stocks. Simply invest consistently in a low-cost S&P 500 index fund. Set it to automatic and do not look at it for 10 years. Let the machine work. Get out of your own way. Warren Buffett has given away over $50 billion to charity. He still lives in the same house he bought in 1958 for $31,500. He still eats at McDonald's for breakfast. He still drives himself to work. He did not build $100 billion because he was flashy. He did not build it because he was lucky. He did not build it because he had some unfair advantage that you do not have. He built it because he understood one thing deeper than anyone else alive. Time is the most powerful force in the universe, and the only way to harness it is to stop fighting it. In a world that rewards speed, he chose slowness. In a world that rewards reaction, he chose stillness. In a world addicted to the next big thing, he chose to hold the boring thing forever. And the world paid him $100 billion for that choice. The question now is simple. What will you choose? If this video gave you something to think about, share it with one person in your life who needs to hear this message. And if you want to go deeper into the mind of the world's greatest investor, our next video is waiting for you. I will see you there.